Hello once again. I'm indeed grateful for those who had turned up for our last webinar on Telegram on the 22nd of October. I spoke about REITs and the response was overwhelming. I'm happy to have answered all the good questions asked by my viewers. Today, I would like to give my viewers a treat to thank you for your support by supporting my past webinars and this YouTube channel. In today's video, I will share with you snippets from my webinar on the 3 most important indicators I use to identify a good REIT. If you are keen to retire with the mindset of passive income and how to let your money work for you, this video is especially made for you. Hello everyone, welcome back to SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit that subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. So, what is a REIT? I believe many of you would have heard of REITs before, but just to define, for the benefit of those of you who do not know. A REIT or Real Estate Investment Trust is a company that owns, operates or finances income-producing real estate, allowing investors to pool money to invest in a portfolio of properties like shopping malls, offices and hotels. These companies are professionally managed and they distribute a significant portion of their taxable income as dividends to shareholders, similar to how stocks work. Here, in today's video, I share with you 3 indicators I use to screen for a good REIT. The first indicator I use is interest rate expectations. This is an important indicator as you will need to understand the current and future yield environment to determine whether your money is better off putting into other investments or into a REIT. So, why are REITs usually affected by interest rates? When interest rates fall, REITs benefit from cheaper financing costs, more sustainable dividend yields, and higher valuations, as their distributions become more attractive compared to alternatives such as government bonds. And to understand interest rate expectations, we have to look at certain indicators such as the CPI. We will first look at the US core CPI or the Consumer Price Index and how does CPI affect interest rates. So, what is the CPI? CPI is a measure that tracks the average change over time in the prices of a fixed basket of consumer goods and services like food, housing and transportation. It is widely used to measure inflation or the rate at which the cost of living is increasing. When the CPI rises, it indicates that prices have gone up and the purchasing power of money has decreased. The Consumer Price Index directly affects interest rates because it is a key measure of inflation. When CPI rises, indicating inflation, central banks like the Federal Reserve often raise interest rates to make borrowing more expensive, which slows down spending and cools the economy. Conversely, if the CPI shows falling inflation or deflation, central banks may lower interest rates to make borrowing cheaper and stimulate economic activity. REITs make money from rental income and a major part of their costs come from interest expense, because REITs also borrow money from banks too, as they will need the funds to either make a new property acquisition or to do asset enhancements by renovating an old property. Therefore, the lower the interest rates, the better the net interest income. So, with the Fed lowering the interest rates, then this would mean that REIT investors will benefit from the eventual cheaper interest costs on any new repriced loans. Here in this chart, you will find an actual case scenario of how REIT returns perform relative to the Fed rate cuts and hikes. You will see that when the Feds began to hike their interest rates in 1999 to 2000, which was at the near peak of the dot-com bubble, US REITs returns, the blue line, fell slightly, while US stocks, the black line, increased. But notice that as the Feds came towards the tail end of the interest rate hikes in June of 2000 to February 2001 and began lowering interest rates, we see that US REITs return reversed upwards while stocks began to decline. This contrarian move between US REITs and US stocks continued all the way to 2003. So, what does this chart tell us? It seems from here that US REITs may also be a good hedge against an overall US market downturn. Therefore, understanding the expected interest rate environment will help you in determining how much portion of your portfolio will be parked into REIT. The next indicator I use is called understanding the quality of the REIT's underlying assets and tenants. To identify the quality of the REIT's underlying assets, we first need to look at how the REIT acquires their assets. Most REITs take up debt to acquire assets. Therefore, any debt is risky if not managed well. So, we need to find out and see if the gearing for the particular REIT we are looking at is in line with the industry. As a guide, our recommended gearing for a REIT should be below 40%. Here, you can see a chart of the debt to total assets for all US listed equity REITs. Information such as the debt to total assets on the US REIT market can be found on the NA REIT's website. We also need to look at how a REIT derives its cash flows and how the REIT manages the cash flows that it receives. Do they generate enough free cash flows after taking into account large capital expenditures such as asset enhancements and frequencies on the purchases of additional investment properties? A good tip is to look for REITs that have a track record of being conservative and prudent in their cash flow management. Its track record must show that the REIT only makes necessary large-scale investments when the market is favorable and in accordance to its business or investment objectives. Here shown is a chart that demonstrates the liquidity sources versus the annual interest expense for each REIT sector in the US. From this chart, you will see that REITs with the largest cash pile belongs to the timber and data center sector. It is important to also understand who the asset manager leases their spaces to. Are the tenants reputable businesses? Who are its anchor tenants? Is the REIT overly concentrated in a particular sector? What is the average occupancy rate of the REIT in its niche market relative to its competitors? I tend to like REITs that have a continuous occupancy rate of over 90% and a weighted average lease expiry or WALE of at least 3 years or more on its entire portfolio. The third indicator I like to share and usually look at is the importance of having a good REIT sponsor and manager. So, what are sponsors and managers? Sponsors are typically the owners of the properties who sell their properties to the REIT at fair value to free up their capital and balance sheets, while managers manage the properties of the REIT for the unit holder. All the information about the REIT structure and its management can usually be found in the REIT's annual report or website, shown here as an example for a US REIT called United Hampshire. You can see here that its sponsor is actually UOB Global Capital. It is therefore important before investing in a REIT to identify who the sponsors and managers of the REIT are. The sponsors must be a well-established player in the property market with strong financial backing and have a huge portfolio of property assets and a sizable land bank, while a good manager must have a decent long-term track record that is consistent with their goals and stay aligned with the unit holders. I identify managers that are usually proactive in their portfolio management by value adding to their portfolio of properties and at the same time prudent in their risk management. Managers who do this usually manage their tenant mix quite well and revamp their properties and tenants. Another important factor is also to look at the manager's remuneration, incentives and fees to ensure that they are in line with market by comparing the payment structure of its competitors. Top executives of the manager must also have the relevant experience and past track record in managing a REIT or property-related business successfully. Information of the manager's fees can usually be found in the REIT's annual report, as shown here for United Hampshire REIT as an example. Remember, to build a meaningful portfolio with a long-term horizon, it is time in the market that is very important. Treat your investment portfolio like a regular savings account by setting aside a reasonable sum of money to invest, say monthly, and let the power of compounding do the work for you. The more allocated capital you have in REITs over time, the higher your distribution payouts. And if these payouts are reinvested every time you receive them, then you will see the power of compounding take effect over time. Of course, to reach such a huge distribution payout does not come easy. You will need discipline in money management. You will have to start investing young so that you have more time in the market to compound your money. In my upcoming episodes, I will share with you tips on how I manage my money prudently, so stay tuned. I hope the community here has learned and gained something today from today's video. For more information on how you can optimize your portfolio and would like to seek advice on your current investment portfolio, speak to us by replying to the WhatsApp link in the comment section and our team can provide a personal touch and talk to you about your investment plans. See you in my next video. Goodbye.